Today, the inflation headfake or something more. Hello again, it's Martin North from Digital Finance Analytics, well, that is Post, covering finance and property news. Well, Wall Street is opening higher on Thursday after producer prices data provided further evidence of inflation cooling in the world's largest economy, and stoked hopes that the Federal Reserve will soon end its monetary policy tightening. Now, of course, headline and core inflation in the US rose at a slower than expected pace in June, as reported yesterday, potentially bolstering the case for the Federal Reserve to wind down its monetary policy tightening cycle after a widely anticipated interest rate hike at its upcoming policy meeting later in July. The Bureau of Labour Statistics' closely watched consumer price index decreased to 3%, down from 4%, and economists had forecast a rise of 3.1%. Now that's the lowest level in more than 2 years and represents a steep deacceleration from the 9.1% reached in June last year. On a month-on-month basis, the reading grew by 0.2%. That's up from 0.1% in the prior month. Estimates had called for 0.3%. And meanwhile, core CPI, which strips out more volatile items like food and energy, cooled to 4.8% annually and 0.2% monthly. Expectations were for both measures to decline to 5% and 0.3%. Despite the headline number inching ever closer to the Fed's 2% target, stickier core figures fueled speculation that the central bank will raise interest rates later this month, after pushing the pause button in its hiking cycle in June. In fact, there's more than an 88% chance that the central bank will roll out a quarter-point jump in borrowing costs at its July meeting. So, whilst the US inflation is coming down and deeper dives into the data don't dispel that notion, it's really important to understand that not everybody is seeing it the same way. For example, if you look at the headline, including everything tracked by the Bureau of Labour Statistics, it's dropped very impressively to just below 3%. That happens to be in the upper range of the Federal Reserve's inflation target. And breaking down year-on-year inflation into its component elements shows that energy now has a negative impact after fuel costs drove the spike in 2021. That's not surprising. And perhaps more impressively, core goods inflation, which was running hot at the beginning of last year, has dwindled almost to nothing. And core services, the source of the greatest current anxiety, is also ticking down, but just a bit. And I suppose you could argue that this is exactly what the Fed would want to see happening. But it's unwise to put too much weight on month-on-month data, which can be very volatile, even if it tells a positive story. During June, energy prices did increase a bit, but the monthly data showed that core goods and food inflation dropped to zero. Core services was the lowest in 2 years, so that is encouraging. Other indicators also tell a bit of a story too. For example, the Atlanta Fed produces indices on sticky inflation for goods and services whose prices are difficult to change. Rising stickiness can be particularly damaging for attempts to bring inflation down, but the problem seems to be coming under control, particularly when using a super core rate that excludes shelter. Most are still holding with the Fed's line that rates do need to go higher to crush inflation, but there is a growing body of opinion that rising rates again could be a mistake. For example, Ryan Sweet, the chief US economist at Oxford Economics, says that the surprise wouldn't deter a hike. The central bank has painted itself into a corner as Fed officials' communication has signalled that another rate hike this month is essentially a slam dunk, he said. However, the new data could give the Fed reason to debate whether any further rate hikes after this month are needed. Jay Hatfield of Infrastructure Capital Advisors warned of yet another policy error by raising rates in July, although there may be a dissent from governors such as Austin Goolsbee, president of the Chicago Fed, who rejects the Fed's myopic focus on the labour market and wages as the key driver of high inflation. The Fed might also be a prisoner of its 2% inflation target. Kristen Biddley, head of North America investments at Citi Wealth Group, said they're very adamant in their messaging that they're still far away from the 2% inflation that they're targeting. And I think that last mile is something that can be very complicated in managing directionally. Do we anticipate any significant increase from here? No. So the tricky thing ahead, of course, is the delay in the transmission of higher rates already made into the real economy, which can take somewhere between 12 and 18 months to come through. Plus, of course, we've got the reversal of recent base effects, for example, from energy, which helped to lower rates recently. They're now turning around. And, of course, services costs continue to rise. And there is also the need for the Fed to see unambiguous evidence that inflation is beaten. And talking of that, the number of Americans who applied for unemployment benefits last week fell by 12,000 to 237,000, indicating most companies are reluctant to fire workers despite a slower economy. New jobless claims declined from a revised 249,000 in the prior week, according to the government data. Unemployment claims typically rise when the economy weakens and a recession approaches. Claims have moved up this year from historic lows, but they still aren't pointing to a big deterioration in the labour market. So, whilst the economy has lost some steam since the Federal Reserve began to jack up interest rates last year, it's still growing and producing plenty of new jobs. And yet inflation is still running far too high for the Fed, in part because of rising wages spawned by the worst labour shortage in decades. The central bank is watching wages closely to determine whether it needs to keep raising interest rates and potentially trigger a recession. And wholesale inventories in the US were unchanged in May following a decline in the prior month, indicating businesses are producing or stockpiling fewer goods due to an uncertain economy. Sales in the month were down 0.2%, the government said on Monday. The inventory to sales ratio rose to 1.41 months from 1.40 months, and a year ago the ratio stood at a much lower 1.3. The ratio reflects how long it would take a company to sell all the goods sitting on warehouse shelves. The higher readings this year suggest it's taking longer for companies to sell their goods, a sign of a slowing economy or an excess of unsold products. Businesses are likely to respond by further reducing inventories. So this is further confirmation that inflation in the pipeline is indeed beginning to wane, said Peter Cardillo, chief market economist at Spartan Capital Securities. So markets have fully priced in a 25 basis point rate hike in July, and traders continue to expect a 21% probability that the central bank will hike borrowing costs at its November meeting. But of course, there are so many cross currents. The markets, though, will react positively to this news, I think, as it did yesterday, because they do believe, I think, that ultimately rates will come down, but not for some time, but may not go as high as people were expecting even a week or two ago. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.